Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
This spread strategy ultimately helps us offset some of that risk by being less impacted by that volatility factor. So what we can see here is in fact a risk-reward profile of this YUK spread. Now, typically what we'd like to see is at least a 2-to-1 return on our capital. Here it's a little skewed a bit in the sense that we're going to put up $207 to make $193, and incidentally the example here is simply just with one option contract. But the idea is that our break-even point sits in and around that $77 mark there, $77.07, and we in fact start to make money and on anywhere beyond that particular break-even point. So if we wanted to lower our break-even point, what we could do is we could in fact sell a lower strike price. So instead of the 79s, we could go down to the 78s and capitalize on writing those option contracts. That'll bring in more premium and lower our break-even point. But at the same time, we want to make sure that we have some upside potential as well to take advantage of, and that's where that 79 strike comes into play. It gives us the benefit of being able to capitalize on a 3-point move or so in this pair value before we cap our profits. Now, the bear put spread is a similar way that we can capitalize on offset some of our volatility premium and lower the cost of our option contracts, but when we're taking advantage of a bearish opportunity. So what we're looking at is, first of all, we need to establish our directional bias. So are we, in fact, bearish based on technical observations or what have you? It's going to be completely up to you. But the idea is that we're going to buy one put option. We're going to go in and we're going to sell one lower strike put option to help offset the cost. It's going to be on the same pair value, of course, and the same expiration date. So in this case, yesterday I was looking at the U.S. Euro, and the expectation was that perhaps we've seen a very significant rally over the last couple of months, and we're thinking that maybe we're going to give a little bit back within the next couple of months. So in other words, what we want to do is we want to try to capitalize on a drop after we've hit a fairly significant resistance level, and after a fairly significant move. We want to capitalize on a drop in the EUI, but we understand that, of course, once again, option contracts are relatively expensive. So the idea was that we could go in and we could buy a put option at the 75 strike, but then turn around and sell off a put option down around the 72.5 level, capitalize on this move to the downside, and that may just be a retracement or it may be an all-out change in trend. But either way, over the next couple of months, we can capitalize on the difference between the 76 strike down to the 72.5 strike. So our cost or our profit is going to be the difference between the spread. In this case, you can see 75 down to 72.5 minus the net cost of the trade. Now here you can see as well that based on our yesterday's calculations, that the historic volatility of the EUI was sitting around 12.29, and the implied volatility of the actual option contracts were sitting in at around 17.06. So again, you have about a 4%, 5% increase in implied volatility over the actual historic volatility, which is suggesting that perhaps these option contracts are a little bit more expensive. So when we take a look at this particular example here, we can see that we have our, in this case I went November, went a little bit more short term. We can see that we have our November 75 puts, and the ask price is a 30, and we can sell off the 72.5 puts and collect 42 cents. The net cost of that particular spread is going to be the $88 here, or 88 cents per contract. And of course, we always have to factor in the commissions. Incidentally, these particular snapshots are from the Options Express platform. So I utilize their trade calculator feature in order to go in and run some of these strategies, if anybody's interested. And once again, you can see down here that we have a number of variables that are being calculated out within the particular spread to come up with the net cost, number one, but also the net vega of the position as well. So in this case, you can see here that the vega of the November 75 put is 10.33. The vega of the 72.5 put is in fact 7.51. Because we've sold that particular option contract, the vega is actually an offsetting factor, so we subtract that from our long option contract, and you can see that the net vega of the position is 2.82. So once again, what we've done is we've eliminated the volatility factor. We've created a strategy which has offset the cost of the expensive option contract and taken much of the risk out of having the position lose money because of a contraction of volatility. What we've done is we've created more of a pure play on the underlying pair value and less of a position that's reliant upon the actual other variables that are influencing how an option trades. So again, 2.82 versus 10.33. So you can see here that this is the risk graph associated with this particular strategy as well, and this is a little bit more of an attractive risk versus reward proposition. We're actually going to risk $88, but we have the potential of, in fact, making about $162, and this is, of course, on one contract. You can multiply it by 5 or 10 or 20, depending upon what your, what your comfort level is. But the idea is that we put up 88 cents to make approximately $100.62, or $88 to make $162. Now, with all the benefits, which is, of course, a reduced cost, reduced break-even point, all that sort of thing, we have to understand that if we're extremely correct in the move, and it actually, the EUI continues to sell off and keeps doing so over the next couple of months, we cannot make any more than the difference between the spread minus the premium that we've paid out. So while we have a reduced risk exposure, we have a lower break-even point, the trade-off is that we have actually limited our profit potential. Okay, so that's what we have to recognize as being the trade-off when creating this strategy. But there are some benefits in doing so, in the sense that if I go back and I take a look at the actual position here, we understand that it would cost us $1.30 per contract in order to buy up these call options and take advantage of the trade. Now, if we have a limited account size, we understand that we may only be able to allocate a certain number of a certain amount of capital to this trade. So let's say, for example, we only want to put up about $1,000 to $1,500 for this transaction. Well, that means we could buy 10 of these put options, but ultimately, if we create this spread strategy, because we're lowering our cost basis, we could perhaps even buy 15 spreads. So what it does is, although we're giving up a little bit of the upside profit potential by cutting off the profits beyond the written strike price, what we've done is we've created a situation here where, because we're putting less capital into the trade, we can buy more of these spreads, thereby benefiting from that shorter move a little bit more effectively. So we're offsetting our cost basis, which is allowing us to participate with to buy more contracts. Now that becomes extremely beneficial if you're looking at taking profits off the table as the trade moves in your favor. So in other words, let's say we have an account that only allows us to buy maybe 3 put option contracts. Well, in that scenario, we might have to just consider taking all of the puts off the table to lock in our profits, where if we could buy 6 spreads, we could take 3 spread trades off the table at any time that we see we're profitable, and then turn around and ultimately have the other 3 sitting there participating in a continuation in our expected direction. So there's a number of considerations here that I wanted to put into perspective with respect to the Vega. So first of all, a long option contract will benefit from an increase in implied volatility by the amount of the Vega. When you create a spread, you lower the net Vega. So what does this mean? Well, the spread will not profit as typically expected with a quick volatile move in the underlying pair value. I've seen this on many occasions where individuals go in and they use a spread strategy to participate, and then they see a really nice move in the underlying, and they wonder why they're not profiting as much. Well, what happens is we're actually not able to benefit as significantly because we've lowered the Vega. We've lowered that impact of implied volatility. So remember, when implied volatility increases in our favor as the long option contract holder, it actually increases against us as the short call option writer. And so it really offsets one another in that regard. And so our expectation when we create these spread strategies is not so much that we expect a very quick move in our favor. If that's the case, then we may be more inclined to just simply buy a straight-up call or put option. Our expectation is that we're going to get a nice, reasonable increase in the underlying security and benefit more so from the move in the underlying pair value, and as I said before, less in the actual from the other variables. Now, the reason to gain is that the short Vega, which is sitting here at 10.33, and I'm using the EUI as an example, and this is the put option, is actually offset by the long Vega, which is the November put option here, the 75 strike, is actually offset by the short Vega. So even if we had a 2% increase in this particular Vega here, so we went up to 12.33, well, let's say this went up to 9.51, so another 2% increase. Well, the net result is going to be the exact same thing, so we're really not going to see the benefit of that. Now, just a quick question from Kevin online: are the EUI and YK Forex is it Forex or is it stock? And if so, can we trade these through a stock broker, a Forex broker, or a commodity broker? Well, so the YK and the EUI and any of the ISE FX option pair values are priced based on the currency market pair value. So what happens is, in the case of so they are option contracts that are priced based on conversion from the spot market value into the ISE FX options pair value. So, for example, if we were looking at, and I'll just throw out the Canadian dollar, for example, which is at 1.0425 today, then the translation in the ISE FX option pair values would be multiply that by 100, and we would be looking at 100.42 as essentially the value of the actual index. So these options are traded based on an underlying index value. They are cash settled, and they are traded through any standard brokerage account. So while they are reflecting a move in the currency markets, we can actually participate in that currency market move through our any standard brokerage account. And as I mentioned here, I'm using the Options Express platform, which is a typical options brokerage firm and stock and options broker, and you can access all of these pair values very effectively utilizing this broker. So hopefully that answers your question, Kevin. They are traded, they are priced based on the currency market, but they are option contracts that are traded through any standard brokerage account. So moving on here, again, the short option Vega reduces the influence of the implied volatility. So instead of 10.33, the influence of a 1% change in volatility is really only going to be 2.82 cents. and that works for and against us. So in other words, we can't benefit from an increase, but at the same time, if we get a decrease in implied volatility here, let's say the 10.33 drops down to 8.33, well, if this drops down to 5.51, while we lose money on the collapse of implied volatility here, we make money on the collapse of implied volatility here, and the net result is still the same. Now, the question always comes up, and Kevin, it's a great one regarding the spreads on these particular option contracts. We've been trading these contracts here in the office for quite some time. And we actually find, while of course there's limited volume on some of the option contracts, ultimately the spread differential is our spread differential is very, very reasonable. In fact, we just participated and closed out a very lucrative trade on the EUI. So what we did is we created a 70 strike call, sold off the 73 strike calls, and closed that out for about I believe it was a 63% profit. So the idea is that even though there's always going to be a differential between the spreads, the ISE and their market makers do a very, very good job at keeping the spreads quite reasonable and tradable for us lowly little retail investors and retail traders. So hopefully that, again, answers your question in that regard. Just another question as well. Let me just take a look. So same question, how is the liquidity for these particular FX options? And as I mentioned, I always, the liquidity and the spread differential, although under a lot of circumstances are related to one another, the important thing for me is that even though perhaps there's been to very little volume on a particular option contract that I'm looking at, as long as spread differentials are reasonable and market maker is prepared to do business, then it's certainly appropriate to trade. You certainly want to keep an eye on that, but we found, as I mentioned, that the spreads are very, very reasonable on these particular contracts. We focus typically on YUK, EUI, CBD, SFC, BPX, which is the British pound, and AUX, which is the Australian dollar. So we stick to the real majors. Of course, there are a number of different contracts or pair values available, but we find that we've had very good results with these option contracts, not just even trading them as spreads, but also just straight up call and put plays. So again, and I encourage everybody just to go in and make your own judgments as you take a look at this particular product, these products, and become more familiar. Take a look and make sure you're comfortable with it. But we found that we've had great results with utilizing these options. And again, the benefit guides, as I mentioned, are typically the way that we would participate in a currency outlook would be that we would have to go to a currency broker and we would trade our views in the spot market. Well, the challenge there is that, number one, highly volatile. It's certainly an entirely different market to trade, and you need to be very aware of that. And in certain circumstances, the risk of loss can be a little overwhelming. Whereas when we utilize the options market, we can still trade the exact same view on, let's say, the U.S. dollar strength or weakness. But now we can use an option contract to participate that gives us an identifiable risk exposure, and we create these spread strategies to reduce that risk even further and participate in our outlook. And the bonus is that we can do this through any standard brokerage account. So again, I'm looking at Options Express here. Interactive Brokers is another one. Thinkorswim. Any of your major options brokers that you would typically trade options through, you can access this market. So it becomes a very, very flexible market to utilize.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.